Hello, my name is Andrew Thake. I'm a divisional director with Resorting Tomorrow. Delighted to be joined today by Simon Popple. Simon sits on our investor advisory board for Resorting Tomorrow, and he also runs the gold program. Delighted to have you with us today, Simon.
Great to be here.
Simon, why gold?
Well, gold, first of all, it's been around for thousands of years. It's not a new kid on the block. It's a tried and tested asset. Obviously, people want returns, and I've got some numbers that, if I'm honest, really shock me, but I think it really kind of hammers home the point of why gold. In 1920, the average house price was about $6,300. And gold was about $20.67 per ounce. So you needed 305 gold ounces to buy your average home. In 2025, the average house price is about $450,000. The gold price has shot up to it's over $3,300 at the moment, but let's say $3,225 an ounce. So in today, you only need 140 gold ounces, which is less than half, to buy your average house. So gold has done phenomenally well as a long-term investment.
And can you tell us a little bit about the gold program? Who is it for, and how does it help them?
Well, it's for people who want to have an allocation to gold in their investment portfolio. What I do is I show them how to put a portfolio together. The foundations of this really are physical gold, and some people perhaps don't have enough money to invest in the gold program. I think you need probably more than $5,000 to be well diversified. But if they've got less than that, then I show them how they can get some physical gold. I don't charge them for that. That's free. But if they've got more to invest, then I show them how to put a diversified portfolio together. I use a fantasy football format. So the physical gold is your stadium, training ground is a fund, and you've got goalkeeper, defenders, midfielders, and forwards, which are different types of companies. And I show them how they can put a portfolio together. The aim is to beat a 10.6% annual return, which is what the gold price has done in sterling terms for over 25 years, actually since 2000. So the idea really is to give people a liquid portfolio which has got decent returns and is invested in an asset class that has been around for thousands of years and people know and love.
And do you prefer a value investing approach, focusing on undervalued gold majors, or are you more inclined towards growth-orientated juniors with high risk, high reward potential, or is it more royalties, or is it a combination of all three?
It's really a combination of all three. I mean, that's why I've got this fantasy football format, because a lot depends on where people are on their investment journey, how old they are, how much money they want to put into gold, what their appetite for risk is. If they like risk and they really want to be in the sector for risk, then I tend to lean more towards the juniors, where you can get some stunning returns, as you know, from some of the people who've attended your events. But if people have got a lower appetite for risk, then I tend to be sort of helping them have more of the really large companies, market values often over sort of 10, 20 billion. So, very large companies.
And for the gold sector this year, if you were asked to identify a couple of trends that you expect to see over the next sort of 6 to 12 months in terms of the gold price and I guess opportunities in investing in gold, what would they be?
Well, I use the term MIDI in terms of what drives the gold price, and it's an acronym for market uncertainty. I think we've got bags of that at the moment with wars and tariffs. Interest rates is the I. Lower interest rates are actually better for gold because the opportunity cost of holding gold is lower, because obviously it doesn't pay any income. D is for debt. That just seems to be going one way. and the other eye is for inflation, which seems to be going up. So my personal view is that those drivers are key to the gold price, and they all seem to be going in the direction of a higher gold price. So I'm very comfortable with the gold price where it is, and I'm hoping it will go up rather than down.
When you are investing in a gold mining stock, what are the green flags that excite you, or conversely, the red flags that put you off?
Right. Well, I mean, I think a lot depends on the type of company, because what I'm going to tell you about, again, I use an acronym bridge system, but it tends to be more for the smaller companies, because with larger companies, these elements have often been analyzed. But basically, for a smaller explorer, I would look at something called the bridge system. So I would look at the balance sheet to make sure that they don't have debt on. I'm very concerned about debt for explorers, because they don't actually generate any cash. So how they're going to pay the debt off. R is resources. I like companies with not only large resources but large deposits. And again, you need to be a little bit careful. You can see, some companies they'll flash out a massive resource, but if that's over lots of different deposits which aren't economic, then that's a bit of a red flag. I is for infrastructure. You need to make sure there's roads, rail, power, and water nearby. D is diversification. I like it if they've got more than one project, so all their eggs aren't in one basket. Grade. It's good to know what grade they've got and how deep it is. And the E is for exploration potential. Obviously, you want to look at companies where there's plenty of potential.
Mm-hmm. There's been an increased concern this year about geopolitical risks, such as resource nationalism and supply chain dependencies. Are there any regions that you avoid due to geopolitical concerns?
I wouldn't say so much what I avoid, but I tend to focus on Australia, Canada, and the US. There are lots and lots of opportunities there, and therefore I tend to focus on those regions, because I'm more comfortable investing there for largely the reasons that you mentioned. The last thing I want to do is worry about some sort of nationalization or something like that. So I tend to focus on more established markets.
If you were to advise somebody listening to this interview one book or three books to go and read about either the investment, the gold, or the mining industry, what book or books would those be?
Well, obviously, I've got my own book, which is The Beginner's Guide to Investing in Gold.
Good choice.
Little plug there. But yeah, I mean, that is really for people new to the sector. If they're looking to get more advanced in terms of their investments, whilst I think books are very good, I actually think going to your show is an excellent way of kind of understanding the market, because you can actually arrange to meet the managers and talk to them, and I find that's actually a very useful way of understanding the market, because if you sit down with someone, you want to do your homework at least on the sector. You don't want to come across as stupid, and I think that forces you to to do a bit of research, and at least understand the basics of the companies and things like that. And that's what I try and cover in my book. But there's other books that cover gold itself, but I think actually just going to the show is very helpful, because people will, if they realize that you don't perhaps know as much as you should, that they can actually be very helpful in guiding you in the right direction.
And then if you were advising an investor who it was their first time at resourcing tomorrow, they're perhaps like a high net worth retail investor, in their sort of 50s, looking to retirement, and they've got meetings lined up with a bunch of CEOs, what would be, the top 3 questions that they should be asking a mining CEO?
Well, I think there's questions they want to ask themselves first in terms of what do they want to achieve, because you want to make sure that you're meeting the right companies that can potentially deliver your goals. But I would say that the key things they need to look at are where the assets are. We discussed nationalisation, things like that earlier. You want assets to be in areas that they're comfortable with, so that they need to make sure that they're comfortable with that. I think it's always good to know what the share price currently is, whilst I wouldn't advocate necessarily, always looking for the 12-month low. You want to be a little bit careful about, if you're investing at the all-time high. So I think the share price is relevant as well. And I think costs are very important. It's very easy to get excited by what the gold price is, but you need to keep, there's 2 elements to this. The gold price is the revenue, and then you've got your costs. And a lot of people get excited about the revenue, understandably, but you do need to keep an eye on costs and ask them what their all-in sustainable costs are, and then compare that with others in the market, and see if they're above or below, or where they are, and if they're significantly different, it's probably worth asking why.
And just on costs, how much would you expect a junior mining exploration company to be spending on exploration, and then how should that compare to its total costs?
That's a very difficult question, because a lot depends on where they are, how many holes they're putting in the ground, and things like that. But one thing I like to look at with the juniors is, first of all, how much they've already spent. I like to look at the track record of the management, because what you tend to find is if management have got a good track record and they found gold or whatever they're looking at before, then there's probably a good following of people who are prepared to put more money with them. If they haven't got a good track record, and they've burnt through quite a lot of money, it'd be more difficult to raise more money. So I think looking at management is actually important. And as I said earlier, you don't want to see any debt on the balance sheet. But what you can do, just to make life quite easy, is to look at how much they spent in the last 12 months and compare that with how much cash they've got on their balance sheet. Let's say they spent $1 million in the last 12 months. You like to see them have $1 million on their balance sheet, so they've got money for the next exploration. If they haven't, and the management have got a good track record, then it's not unreasonable to think that they could raise capital on decent terms. But if they haven't, and management have got a lousy track record, then are they going to be able to raise enough money to do the next exploration program? And I think that's a very important fact.
Well, thank you much for your time today, Simon. I would encourage anybody listening to this to please go and check out your gold program, and we look forward to welcoming you to resourcing tomorrow. Thank you very much for your time, Simon.